I have a friend who's a creator, and he says one very interesting thing, right? He says that brands need to be better and start thinking like creators. And creators need to be better at business and start thinking like brand owners. And the person who can straddle in between this in 2023, 24, 25, 26 is the person who will have success.
Welcome to this premiere episode of First Unicorn Chats. Whether you're a founder looking to build your first unicorn, or you're an angel looking at investing in your first potential unicorn, you've come to the right place. We bring you some of the sharpest minds from the global startup ecosystem. Our aim with this podcast is not only to give you an insider's view into the world of venture capital and entrepreneurship, but also highlight the habits, structures, and mindsets of those who have succeeded in this cutthroat world of business. Our guest today is Arjun Vaidya, co-founder at V3 Ventures. You may know Arjun from his previous avatar as founder of Dr Vaidyas, which went on to become India's first D2C exit. Since his exit in the last 2 years, he's made 85 odd investments, set up V3 Ventures, and built a personal brand like none other. He's a prolific angel investor, an entrepreneur, and someone I'm very lucky to call a friend. Enjoy this very first episode of First Unicorn Chats. All right, Mr. Arjun Vaidya, super pumped to have you here, brother. How are you doing?
What's up, Raj? I hope is this the first
This is the
episode?
premiere episode. Yes.
Wow, wow. So I'm honored. I'm honored to be on this.
No, it's great to have you here. Yeah. And I'm actually going to begin this podcast by picking up where you and I left off the last time we met in Bombay, right? Which is personal branding. Just to align the listeners, Arjun went from he's actually one of the few VCs who's leveraged the power of social media to build his personal brand, right? So my first question to you, Arjun, is that how do you go from building a D2C brand to changing your mindset to building a personal brand? What was the journey in the middle?
Look, I think firstly, I'm not so structured about personal brand, right? I think um, I just have had some experiences which I want to talk about and I want to share. And so I started sharing them on a platform that I used to use a lot, LinkedIn. Not so many people are sharing things on LinkedIn. I like the platform. I found it professional and I found people talking about things I was interested in. So I started writing about it. And then, like, with time, once you do it consistently, you realize that people are actually listening, right? And so when you realize people are listening and it's actually making some impact, then you want to do it more and more and more. So I think, look, Raj, there's two ways to do it, right? One is to say you're a creator, to talk about what's trending, what's important, what people are talking about. And I have a lot of respect for people who do that, right? A lot of my friends are creators. I learn a lot about how they are, and I try to implement some of those things in the way I speak as well. But I'm very clear, I'll only talk about things I know about. If they are niche subjects, so be it. But in that niche, I'll be sort of somewhat relevant, right? So, for example, I did a podcast called Direct to a Billion Consumers. I only did it audio, and most of my listeners were on Spotify. Used to get like 3-4 thousand listens
Wow.
per episode, complete listens. But that's the D2C ecosystem in India, right? So I did not endeavor for 100,000 listens because I just wanted every D2C founder in India to listen to it. It was a nuanced conversation. It was pretty complex, actually. And the people who had to listen to it, right? And then eventually, when you start doing it more and more, you get better and better. And uh, I think, look, people ask me like, how do you have so much time to write on LinkedIn? How do you have so much time to share? I think it's my job,
Right.
right? Like, think about it. Uh, as founders sell their businesses and pitch to investors, I want to be the top of mind guy for any consumer founder when they are starting up, right? And so, what are the two metrics that I sort of judge myself on, and I have to do what I can to get there. Number one, are at least 70% of the good consumer founders when they are starting or when they are raising or when they are building their business, reaching out to me or getting connected to me? And number two, do I at least get 70% of my LinkedIn messages replied to? If I'm doing those things, then I'm good at my job.
Right.
Right? And that's the metrics I hold myself.
So is this are these metrics the second order effects and third order effects of actually writing on LinkedIn? Uh, did you go with a strategy when you were did you when you exited, or so something that you discovered?
How did I start writing on
Yeah.
LinkedIn, right? I started writing on LinkedIn because we operated a business through the early part of the first lockdown, right? I ran my business pretty much every day from April 1st, 2020 to June 30, 2020, when most of India was shut, right? After that, things started opening, etc. And those were some wild times, right?
Yeah, yeah.
And those stories had to be told, right? Like unloading a 750 kg tempo with 5 or 6 people, um, going to the warehouse and packing orders every single day, um, going and sitting in the BMC office to reopen our factory, uh, launching 7 new products in those 3 months, running a small R&D setup in my office to get those products out. Those are stories that need to be told. Um, we used to pack about 5 to 10,000 orders a day between 6 people. And so we wanted to do as much work as we could at home so we were most efficient in the warehouse. So we take the courier bags and pre-label them at home. And I mean, I had my mom, dad, some of the staff at home, my brother, and my grandmom. My grandmom was like 79 years old at that time. And she was labeling courier bags. That was the first LinkedIn post that went what I thought was viral, right? 17,000 views I got for that post at that time. And that time I thought it was a big deal. But that was the first post where I was like, okay, people actually care about what I'm saying.
Right. No, very interesting. Yeah. And you also teach a D2C cohort, right, on Growth School or something like that. And
Correct,
I'm
correct.
quite curious, right? Because what do you tell, fresh D2C founders about, hey, this is how you build your product brand, and this is how you build your personal brand, and this is how the two are linked. Is there something that, from both these experiences that you've
Yeah,
got? So
yeah.
how does that conversation go with them?
So we have a module 3 in the D2C cohort called Building a Brand That's More Than a Logo. And we talk about 9 steps. The eighth step is wearing your brand on your sleeve or embodying the brand. And for that, the slide is me proposing to my wife with a packet of Live It Up before I gave her a ring.
Right.
And that LinkedIn post screenshot
Oh,
is
wow.
that, right? So I'm a big proponent of wearing your brand on your sleeve. And it doesn't have to be, by the way, creating content, right? It could be talking about your brand everywhere you go. It could be wearing a t-shirt. Like I wore a Dr. Vaidyas t-shirt every single day to work till a point where my father-in-law, who's in the garments business, said, dude, you can't wear a t-shirt every day. So he made me shirts with my company's logo. But he was like, it looks a little bit tacky that it says Dr. Vaidyas. So he just took the 3 leaves and he made shirts with that. And he put proudly Indian on the sleeve and that's it. Right. So it could be any of these things. It could be talking about your brand everywhere you go. It could be selling everywhere you go. Like I would try my best to ensure that all my friends' weddings had my hangover product, Live It Up, right? That was embodying my brand and living my brand. Today, if you meet me at a party, in my back pocket, I'll always have a packet of Live It Up and I'll take it out while I'm having my first drink and show it to people. That's also embodying your brand. Right? So it's not just about creating a personal brand because, writing content, sharing, it's not for everyone. Like, I tried to convince my wife to do it because she has some amazing stories to tell and very different from mine. But it's not for her. It doesn't come naturally to her, it's not for her. And so she can't do it as much as I can. But there's other ways she does it.
Right. But I think another very good point that you touched upon, right, is also that there's always a story both behind building a personal brand and even behind building a just product led growth that you want to do around D2C, right? And that goes across the spectrum. It's not limited to D2C. It is. I remember when I started Disruptors as well, right? People used to ask me, "Hey, why is the infinity sign?" Right? So I already always had a story at the back. Even now, our new venture is called First Unicorn, right? And the first response to people is that, hey, why this name? And I was like, look, I know a lot of people who like to invest in startups, and I'd like to help them find their first unicorn. But yeah, so it became FU Capital, right? I was like, hey, that's the side story. But the point is that personal branding and product branding, it kind of goes hand in hand, right? And the
Absolutely.
better you can do the two together, it works out the best.
I have a friend who's a creator, and he says one very interesting thing, right? He says that brands need to be better and start thinking like creators. And creators need to be better at business and start thinking like brand owners. And the person who can straddle in between this in 2023, 24, 25, 26 is the person who will have success.
That is so on point. That is absolutely on point. Yeah. No, I think that hits the nail right on the head. We're gonna move to the next part, Arjun. Right. The next segment is basically around angel investing and venture capital. Right. For the listeners who don't know, Arjun is a prolific angel investor. Case in point, this is a true story. Right. Last week, I had two back-to-back meetings with two founders, and I was asking them, "Hey, who are the other angels who've committed?" Right, both those meetings, you had those exceptional founders, and you had committed to both of them before I had, right? Which also goes on to say, talk about the edge that you have in actually building the brand, right? So walk us through, Arjun, what your process is in terms of committing to, let's say, a fresh founder. What do you look at, and your process of angel investing?
Yeah, look, I think I'm not so experienced, so the returns will come in the next 2, 3 years. Then we'll see whether I did well or not. But I can walk through my process, right? I think in an early stage investment, angel, not angel, from a VC fund, I run a VC fund as well. 50% of your bet goes on the founder, and so I have three things I look for in a founder: who is the person, why do they have a right to win in
Hmm.
that space? Like, for example, I am who I am, but I also had a right to win in Ayurveda because I have 150 years of
Yeah,
family legacy and a lot of IP in that place. And the third, why will they fight through tough times, right? Like, what do they have that will make them fight through tough times? Because reality is, look, Raj, any founder you speak to in any business, it could be a decacorn as well, will have had near death moments in their
absolutely.
startup, right? I read this beautiful book, one of the best books on the Indian startup ecosystem by Sid Rao, who's unfortunately now passed, called How I Almost Blew It. And he told the story of Anupam Mittal and Kunal Shah and Deep Kalra and the Book My Show story and the Flipkart story. And all of these stories had a how I almost blew it or a near death moment, right? And so I think the third characteristics of grit and resilience in a founder is very important. So I would say 50% of my bet or weightage goes here. 20% specifically in consumer goes on market size because most of the people who angel invest or VC invest come from this Bombay, Delhi, Bangalore ecosystem. And my dad used to always say, you don't live in India, you live in a country called South Bombay. Your consumption is the same as someone in New York, LA, Miami, Hong Kong, San Francisco, Dubai, but that doesn't tell you about India consumption. I'm gluten free and sugar free. I can tell you that gluten free plus sugar free in India, less than a million people. Less than a million people who actually follow that, right? So it would be a very healthy decision, but a very non-prudent investment decision to invest in a gluten-free plus sugar-free company. Right? And so I think thinking about a really large market size from the time of my investment, right, is very important for me. And so 20% of my weightage goes on, hey, from here, is there 5x, 10x growth even possible in this market? And then the third thing is the more standard stuff that everyone looks at, right? Which is business economics and team. So if you look at a consumer business, it'll be revenue growth velocity, gross margin, contribution margin, bottom line, customer acquisition cost, lifetime value, repeat rates. And then we can't under index on team, right? Because one or two people cannot build a business. Even WhatsApp, which is one of the most efficient companies when it sold to Facebook, had 15 people, right? It was not just the founders, there were 15 people. And so who are those people that are enabling the founder to really make this happen? That's three. So 50% founder, 20% TAM, and then 30% business economics and team. That's how I mentally model my investments.
Arjun, how do you also invest personally? You also invest through the fund, right? And I know this myself as well because when I personally invest, I have a slightly tweaked methodology versus when I'm using other people's money or investing other people's money, right? Could you give me the that slight nuance of a difference, right? Of when you invest to the fund and when you invest?
I think Raj, it's only one nuance for me, right? I cannot punt when I'm making an investment from the fund. If I think there is a really binary outcome, which could be amazing, or I just want to support someone because I really like them, I cannot do that from the fund. But I can put a small personal check because it's my money and I can do what I want with my money. So I can't punt from the fund.
Got it. I'll tell you what my difference was. So when we were at Disruptors, I had come up with a methodology, right? Which is four buckets. The first was the management factor, which was basically 50% of the weightage. The second was the opportunity factor, which was about 30%. Then the exit factor and the deal terms, right? This is what I used to look at for Disruptors. And in that case, for example, within management as well, we used to look at, hey, how much skin in the game does the guy have, right? Is there evidence that he's fallen down and gotten back up, right? And what is his expertise in the domain? And all of this used to kind of, in earlier the stage, the more important that used to become, right? Opportunity was all about market, product, competition, etc., right? When I was looking at personal investments, right, for me it was very simple. And when I was trying to make quick decisions, it was basically the four T's, right? Team, TAM, tech, timing, right? The only difference for me when I was doing a personal investment was that I used to kind of think about not think too much about timing, right? Because I would, if it's my own money, I have a much longer horizon, right? Because some things have a longer gestation. And from a fund perspective, I used to always think like, hey, I don't want to get into something which is going to leave my, capital growth to be idle for a long period of time. When it was my own money, I was okay with it, right? So I think that was the slight difference for me.
Yeah, I think it's similar thought process, right? Similar.
Yeah, and so Arjun, how many investments have you done so far?
From the fund, we are completed four, fifth one ongoing. Then angel, maybe 85.
Oh my, 85 now. You're gonna hit 100 this year.
But I don't think it's like someone said, that's lots of investments and all of that. My answer to them is India is such a big country, I could do even more.
Yeah,
There's just so many amazing people building things, right? So many amazing people.
yeah,
There are
absolutely.
so many ones I regret I missed.
Yeah, and so if you and these 85 are, I'm guessing, just and what's the time span that you invested this capital in the last 2 3 years? Is it?
2 years. 2 years. I didn't make a single investment, Raj, when I was running Dr. Vaidyas. Not even one.
Ah, so it's all it's
Not
all
even
it's
one.
all after the
Not even one.
exit, is it?
Yeah, I am a very bad multitasker. And so I couldn't multitask. I had an opportunity to invest in some amazing companies. By the way, I was part of the DD of Shiprocket, for example, which is an amazing company because I was a customer, right? So I knew when they were raising their rounds because obviously I did the customer ref check calls. But I just couldn't invest. I didn't have the bandwidth, the mental space, none of that.
Yeah, no, I think multitasking is a myth, man. Like, I don't think most people are good at multitasking. So you might as well do the thing that you do well and just keep hitting the nail there, right? So Arjun, what would be your top tip for founders fundraising in today's environment? Just one tip.
Two tips on fundraising in today's environment: be patient. The reason I say be patient is because 2 years actually made all of us believe that, like, if it took more than a month to close, it's a lot of time. I just want to jog people's memory back to 2018 and 2019, which is not so long away. When I was raising money, it took 6 months, 1 year even to close around. So be patient from that perspective because both sides need to get to know each other, right? This whole thing of doing an investment without meeting someone and never meeting them but still investing in their company, I don't believe in it personally. Like I may be old school, but I have to meet the person in person, right? At least that's my thought process. Second thing I think is build responsibly. That's not just for investing, but sustainability, long term, 10 years, longer horizons, at least for brands. Um, it's back but should have always been there, right? And so you think about responsibility in your P&L, responsibility for your team, responsibility in the growth rate, responsibility in the quality of revenue. All of these things are really important.
There's just a thing that you said, right, which is about you should build to last, right? I'm going to come back to a question on this by the end of the segment. But before I do, right, I'm actually curious to know. We're also all seeing, this younger and younger breed of founders coming up now, right? When I was investment banking, I used to see a lot of millennials like myself, so it was very relatable. Now it is a bunch of even younger folks coming up, and they have different kind of skill sets. They're different people altogether, right? Could you share what your thoughts are in terms of this younger generation and what they need to be, let's say, cautious about, and what are their strengths that they need to double down on?
Yeah, like I think I realized I'm not young anymore when I crossed 30. Like you,
Yeah,
I'm
yeah.
31 now. I think it's really, really important for all of us to have friends on both sides of the spectrum, or have not friends necessarily, but relationships on both sides of the spectrum, right? So for example, I'm part of this group called EO, Entrepreneurs
Entrepreneurs
Organization,
organization,
right?
yeah.
And in this group you have a forum, you have a group of people that you spend time with, you share with, you learn together, and you build a really close bond with. I specifically chose a forum where everybody was older than me, because I said I have lots of friends my age. I want a different perspective in my life. And similarly, Raj, outside of work, I spend a lot of time with people between the age of 22 to 26. Lot of people. Why? Because actually, I also, like, I'm now 31. I'm going to go to my college's 10-year reunion this year. I'm 10 years out of college. I am so different. A generation used to be 10 years and became 7 years. Now, generation is 5, maybe 4 years, right? I am so different from someone graduating from college today. And so I need to expose myself to the way they think, the social media platforms they use, the way they converse, what means something to them and what doesn't mean something to them. I may invest in startups. That may be very risky to my dad as an asset class. They're investing in crypto. That's risky to me as an asset class. They're investing in NFTs. That's risky to me as an asset class. Right? But understand the way this generation functions. What is amazing about this generation is they have grown up in an age of democratized information. And so, what I know, they also know. Earlier, I was a domain expert. I was an industry expert. I had some knowledge that other people didn't have. Now they're like, sir, we know everything about you. We watched all your podcasts, seen all your content on YouTube. Let's start from where that ended, right? So when I talk to someone, they're not like, hey, tell me about Dr. Vaidyas. They're like, okay, now tell me specifically when you exited, how did it feel? Right? So they've grown up in democratized information. They have much more confidence. If I speak to a 23-year-old founder and he or she pitches their business to me, they are as good, if not better than I was when I was 28, 29, in terms of the clarity of thought, the way to make the deck, the way to structure the deck, the way to think of market sizing, outcome, investment, dilution, cap table. These were things we didn't even know when we were 23 and 24. They have that information. I think the thing that this generation needs to learn from us, and we have a lot to learn from them, is a little bit about patience and stability. Don't move on from one thing to another so quickly. And that ambition to grow and grow and grow is good. But that ambition should not move to being fickle.
Right. No, absolutely. You kind of hit the nail on the head here as well. And I think some really smart founders, like in their early 20s, doing some great things. My only asterisk with them, right, at this point is that while they have had more access to information, right, they've also been subjected to more time with these social media algorithms because they've grown up through them, right? So quite a few of if they're not careful and they're not self-aware, right, a lot of them also end up, as smart as they may be, getting into echo chambers, right? That becomes a very dangerous thing in the longer term, right? And
Correct.
that's what I tell them as well, right? That look, you have to hear people who you disagree with, right? It will be painful, but it is going to be so much better for you and for your long-term growth, right? I think if this generation kind of has a finger on the pulse with respect to their, basically not bowing to confirmation bias, right? Which these and because they spend most of their time on a lot of these platforms and apps and social media, that you end up kind of living in that echo chamber, right? So it's very important for them to kind of step out of it. So the moment I figure out, in a young founder who's very smart and they are self-aware this way, right? For me, in early stage, that is just I'm going in for something like that, right? So yeah, I think very very similar thoughts there as well. Arjun, in this environment, right? As an angel investor, what's your top tip for an angel investor in this environment?
Leave FOMO behind. Don't invest because XYZ is investing. Invest because you believe. In the hot market, like people invested lots in FOMO, uh, but in this market, the next round will not happen because of FOMO.
Absolutely. Yeah, yeah, bang on. Which takes me to my next question, which is about, the risk that early stage has risks, right? And of course, capital is in this market a fairly big risk. But beyond capital, what do you think is the number one risk factor for an early stage company today? Or I mean, anytime.
Actually,
Yeah.
lots of risks, right? Uh,
What's the top one for you?
uh, I think the most critical part of any business is not founder, it's not luck, it's not capital, it's not background, it's execution. And so the biggest risk for an early stage company is not executing your 12-month business plan. And that there can be various reasons. Right? It's a big country. There could be competition. There could be legislation change. There could be regulatory issues. There could be difficulty in hiring teams. But not executing your 12-month business plan. It's the biggest risk in an early stage business. You miss it by 10%, 20%, it's okay. You miss your 12-month business plan by 50, 60%, it's big risk. Got to rethink everything.
Right. You know what I think it is? I think if you don't choose your co-founders correctly, right, in early stage, that is the biggest risk.
I actually have a theory on co-founders, Raj.
I'd love to hear
I have a
it.
theory. You cannot find a co-founder. You cannot speed date a co-founder. You cannot find a co-founder on a WhatsApp group. You cannot get WhatsApp intro or email intro to a co-founder. A co-founder relationship is almost equal to marriage. Almost. Because it could end in 10, 15 years. Marriage hopefully doesn't end ever. Dead do us part and stuff like that. You can't find someone like this randomly, right? And even if you do find someone like this randomly, you got to spend 6 months to 1 year of a lot of time together because you meet, everything seems exciting. You guys have never seen bad times in your life, and then when you see bad times, you're like, oh, the relationship breaks, right? Uh, I think you have to choose someone as a co-founder who's someone you know very well. It may not be very long, but definitely someone you know very well. Because you have to see good and bad times together before you get into it.
True. I mean, I've had different experiences, even with longer term relationships, but yeah, I think overall, your point definitely
Like
stands.
I get a message saying I'm looking for a co-founder. Can you recommend someone?
Yeah.
How can I recommend someone for you?
No, we are an arranged marriage society, everything can be arranged, right? So that's the mindset I think that has to be grown out of. Arjun, last question of this segment, right? Around angel investing and venture capital and startups. Um, you've built and sold a company, the first D2C exit in the country, right? And of course, a lot of things had to go right for that to happen. But if you had to do it all over again, right? Do it better, do it bigger, with less of, with more of the knowledge that you have today. What are the top two or three things that you would do differently than you did before?
Yeah, I think first thing is that I hire a team earlier on. I was very weak on team because I was maybe thinking I'd do it myself or I'd figure it out myself. So I'd hire a team earlier on. Number two, I would say invest in brand much earlier on. You have limited money, you're scared that you'll burn through all the money, so you just do performance marketing because it gives you the results. That's a short term way of thinking of things. Luckily, I operated in a different time where it worked. Today, it would not work at all. So I invest in brand earlier on. And number three, I would say that I seen scale, right? And I've seen success now. So I would dream a bit more. Um, like today's founders, and I wrote a LinkedIn post about maybe it's a Shark Tank effect. A founder doing 1 crore a month can easily say the word 200 crores. At 10 lakhs a month, I could not say the word 10 crores. I was scared. Right? And now maybe I've had hindsight, I've seen some success, I've seen other people's success. You're scared of these words. When you're doing lakhs, you're scared to even say crore.
Yeah, that's true.
So I didn't dream enough.
Yeah, I think there's a whole concept around this, right? So once you start understanding big numbers, right, from whichever field that you come from, right? I came from banking, and even in banking, I was in mid-market investment banking, right? I knew colleagues who were in London, doing big numbers and things like that, right? So once you start getting your head around big numbers, right, you aren't really kind of satisfied by just saying that, hey, I'm okay with 10 lakhs and 20 lakhs and things like that. You become comfortable. We're going to move on to our next segment, Arjun, which is around personal finance, right? And I think most people watching this, most people in general want to make a lot of money, right? But oftentimes, their habits, their structures, their just mindset, right, is not geared towards that. So let's start with this, right? It's a softball for you. What was your path to financial freedom?
My exit.
Right.
Until then, I didn't have financial freedom, to be honest. As a founder, you don't earn so much money, right? So I straight out of college, I had a great job. I was paid a lot of money at that time, 2.5 lakh rupees a month at age 23, 24. Then I let go of all of that to be a founder. But my dad made us disciplined about taking a salary. Both and Trisha was at Goldman and then in the UK and then at Nika and stuff like that. So she also was sort of used to getting remunerated. So we took 67% pay cuts from our last job when we joined Doctors. So we had some money at least to be able to take care of our expenses, like whatever little payments we had to do, whatever little like you go out for dinner with friends, etc. We didn't have. I still don't have a lavish lifestyle, by the way. I don't have a lavish lifestyle. I never choose to have a lavish lifestyle. But that little bit we were able to pay and at least do all of that, right? But I think my path was sort of the exit, and then from there it was financial freedom for pretty much. I would say, given that I don't have a lavish lifestyle for the rest of my life.
That's awesome, man. And how is your wealth divided between different asset classes? Let's say public equities, private equity, real estate, gold.
We follow that sort of typical family office investing mindset, right? You start from fixed deposits and you go all the way down to angel investment. You do everything in between, right? So fixed deposits, government bonds, and what we used to do MLDs, we don't do them anymore. REITs, then venture debt, then on the equity side, I'm saying personal portfolio across all of these asset classes, right? So it's a in our family, and we all follow the same, by the way. It's something like 55% equity, 45% debt. We're a little bit more on the conservative side, and I am, by the way, the trailblazer who invests most of my equity in like unlisted early stage and stuff
So out of
like
the
that.
55%
But
equities, you probably have what, 80% in private equity and basically startups. Is that
yeah,
right?
yeah, maybe 65% types. For me, my dad is the exact opposite. He has two startup investments, and that's about it, really. And he keeps sending me stuff like, "Is it bad times?" and things like that. Right? But we follow a structured family office approach, and we sort of manage our finances all together as a family. We're still that sort of traditional Gujarati family mindset. But we do it across asset classes, and I think the one asset class which we invest a lot in, which would be out of the ordinary of sort of the typical financial instruments that are available to everyone, is gold and jewelry, just because that's my family business. And so my dad has, at least we think he has unfair access to information and trends because he's doing it for 35 years. So I mean, like real estate and financial instruments and stuff we do, but
Right.
we also have some exposure to this asset class, which maybe a lot of people don't have.
Right. No, and that's a really good point, right? Because people, when they think about asset allocation, you cannot think about that in a vacuum, right? Because
Yeah.
somebody,
Yes, I used to keep telling my dad, we are so invested in this, so
yeah.
invested in this, and then
But it's about
now
unfair
gold price is
advantage.
at all-time high. Gold price is at all-time high, right? And then I'm like, then he's like, check the price, and then I was like, sell everything.
Yeah, yeah.
And then
No, but that's where the difference comes in, right? If it's the same way he's worried about your startup investments, you have an unfair advantage there, right? Because you have access to
correct,
information, more information than he does. And same, I think the reverse would be true for some other asset class like gold. So I think the balancing of that portfolio is something that should be dependent over time on your competitive advantages, right? And that's something that I
correct,
think is very
correct.
important for people to know at this point, because otherwise there's a very templatized approach, right? 100 minus your age, put into equities and whatnot. But I think it's a little bit more nuanced than that.
Correct. I agree with you. And I hope I have an advantage. We'll
Yeah.
see when the results and the results come out. I hope I have an
Yeah, me
advantage.
too, man. I'm in the same boat as you. What's the worst personal finance decision you've made in your life that you regret?
Uh, Maybe investing in too many startups. I don't know. We'll see. I don't have the answer to that. I don't have the answer to that. Worst personal finance decision that I regret. Maybe I didn't invest as much when COVID hit and the market was at an all-time low because I was scared.
Yeah, but I think
Actually
that,
sold a lot of positions.
yeah,
I sold a lot of positions out of fear, right? So maybe that's a bad decision, but I don't blame myself for it. Right? Those were just weird.
but that's psychology, right? Like the same way you're feeling about when the markets fell March 2020 to 7,500 or something, right? Nifty fell to 7,500. That's a situation of the startup ecosystem right now, right? And people are like, and there are a lot of my LPs, etc. Everyone is apprehensive, right?
Yes.
But it's very difficult to
Yeah.
kind of explain to people that look, valuations are
The
down.
good part about startups is you don't see the share price every day
Yeah,
change,
you don't
right?
see the markup as the markdowns, right? And
Yeah, you don't see it every
yeah,
day.
correct. What's the best personal finance decision that you've made?
Yet to be made. Yet to be made.
Yet to be made. Okay.
Yet to be made. I think I'm really like I thought very deeply about investing in a home, and I always thought it was a really bad decision. Because if you look at rent yields, it's always sort of cheaper to rent, right? But then I think from like now I've had a baby and all that stuff, I think the security of maybe having my own home and sort of buying it myself, I think it's a good feeling. I don't know if it's a great personal finance choice because that capital could have been better invested somewhere else, but I think from a security perspective, it's a great feeling.
No, absolutely. I think that's a great answer as well, right? Because even, and this is a thing which a lot of young folks, right, even including me, at least about until 5 years back, I would think that buying a house is a bad investment, but the security of it all, right? You're not pricing that in,
The security, right?
right? Second thing is that
Yeah.
in a country like India, everybody talks about the rental yield, right, as a percentage of the entire the value of the property. Now the issue is that, and especially in big cities like Delhi, Gurgaon, Bangalore, Bombay, right? I've heard so many stories where rentals are going up not like 10, 20%, where suddenly the landlords come and said, hey, rent is double, take it or leave it, right? So the thing is that while prices might have gone up for housing first, right, and those can become a little bit sticky over time, now rental yields will start catching up. So the thing is that you have to make those decisions not in a vacuum, right? You have to try to understand a bigger picture because India is growing. There's a lot of capex coming in, so rental yields will go up, right? Because everybody will want to come into cities because cities are engines of economic growth. And that means that rental yields will also go up. So I think that that's a really good answer. Personally, I think I'm not sure if it's a personal finance decision, but what one that I expect will serve us well, which you thought was the worst decision. I think startup investments in the next decade or so will turn out to be a great decision because
I hope so, man.
because no be-
I'm
because
not riding on
no
it, so
because
I hope so.
because I think the very basic nature of it, right? The size of the market right now of the venture capital ecosystem in India is very small. right?
Yeah.
And the fact that you are actually participating in it consistently, because that's the form of SIP in startup investing, right? It is different. It is
Correct.
different
Correct.
from public equities. So if you're consistently investing the way
Correct.
you are, the way we are, right? I think that is the decision that's going to turn out well for a lot of people, right? Because you got in early in a
Correct.
smaller market and you got a bigger chunk of that, right? And then you kind of rode
Correct.
the wave. So as long as you're making sensible bets, not trying to just splurge, it can kind of turn out to be a game-changing investment area, right? Final question for you.
As my dad
Sorry.
says, from your mouth to God's
Yeah,
ears.
from my mouth to God's ears. Let's hope so. My final question to you today, Arjun, is that we spoke about the venture capital ecosystem. We spoke about personal finance. What would be your advice to somebody starting up today, no matter the segment, the sector, the age, as somebody who's backing you're literally backing the startup ecosystem with your personal, professional career, everything that you have, right?
Yeah. Yeah.
So your words are going to be quite heavy because you are betting literally your career on this ecosystem. What would be your advice for an entrepreneur starting up as of today?
So I'll talk to two people, right? One is an entrepreneur starting up. Two is someone who wants to start investing. The entrepreneur starting up actually, like right time, man, because the next 10 years in India are going to be game changing. I'm very patriotic with this band with the Indian flag on my hand. I've been wearing it for the last 12, 13 years. But I think just given I'm part of a global setup. Our head office is in Belgium. We have offices in New York, in London, in Singapore, in India. I think India's where it's at. We have free economy, largest middle class, sort of brand aspiration still being built, brand starved nation. The growth is here. And so stay hungry, stay foolish, and keep building for the entrepreneurs. I have a specific advice for people who are wanting to sort of be in the investment world, aspiring angel investors, people want to enter VC, build relationships, right? Raj sent me a message saying, "Hey, dude, I'm doing this podcast. I wanted to be on the podcast." I replied in a second saying, "Yes, I'll do it." I've come back from a vacation. I barely got home at 6:45. We're recording this podcast at 8 p.m. Right? The reason I did it for Raj is because we already have a relationship. Had Raj come to me and said, "Hey, dude, share some deal flow with me," um, I may not even like seriously respond to that message because I genuinely have this way of wanting to reply and help out reply and say, "Okay, sure, sure, sure." But I wouldn't take it as seriously as Raj saying, "Hey, man, let's just catch up. Let's meet for a meal. Let's share ideas. Once in a while, let's talk about deals. But every time we talk, let's not talk about deals, right? Let's not have a transactional relationship." I think that relationships are built with more than just transactions. And if you do that, you can actually build value together.
Right. No, I think amen to that, man. One of the best things that I'd heard from one of my mentors in the past, right? He was like, you want to become a really good businessman. That's the word he used, right? You want to become a really good businessman. Take the transactional out of a transactional relationship, right? And that's how.
Correct.
And I think that's bang on, right? And that's what we do, man. Thank you so much, Arjun, for taking the time
And,
today.
and I'll just give
Yeah.
you one
Yeah. Sure.
example to end the conversation, right? We were to record from 8 to 9. We only started recording at 8:20 because for the first 15, 20 minutes, I wanted to talk to you about you before we started recording this. Right? I would have just been like, "Hey, man, let's record." Right? And I've recorded podcasts where someone has done that with me. They're like, "Okay, cool, let's start." Because I have only 1 hour long. But that's not how it is.
No, I think yeah, that advice is bang on. I think it's something that everyone can actually learn from, and hopefully, I have this relationship with you, right? And I think it's something that I would want to replicate with a lot of other people, right? Because that's what people who are in it for the long term do, right? We're not in this
Absolutely.
ecosystem for 1 year, 2 year, 5 years, right? So that's what I'd like to kind of end this podcast on. Guys, both Arjun and I are very active angel investors. If you guys have ideas, feel free to reach out to him or to me, and we will definitely get you back because Arjun, that's a key metric for us, right?
Absolutely. Awesome, Raj. Thank you so much for having me. And I feel honored to be on the inaugural episode of this podcast. Wishing you all the best for the podcast, man.
Summing up our conversation with Arjun with 3 top takeaways. Number 1, the best motivation for personal branding is to become the top of mind guy for your audience. Case in point, Arjun is the top of mind guy for any founder ideating a D2C startup. Number 2, brands need to be more creative and start thinking like creators, whereas creators need to be more business minded and start thinking like brands. And the person who can actually traverse both sides is likely to find outrageous success in today's day and age. And number 3, building your network isn't about how wide you can go. It's about how deep you can go with the people who come into your life. I hope you enjoyed this first episode of First Unicorn Chats. I look forward to seeing you in the next one.